What did we learn the last time we met? Wednesday was the last time we had spoken together. What all did we learn? Yes, we did chapter number 1, which was all about the FM function. We learned why do we need to do financial management. If I ask you people in a summary, what is the main goal that we want to achieve with financial management? What is the main reason why we are learning all of this? What do we aim to achieve? No, that's not the answer. Why do companies exist? Companies exist to make money. Money for whom? Yes, wealth maximization for the shareholders. Nidhi, Madhumita, you're both correct. Wealth maximization of the shareholders is the main objective of FM. Everything else, every other decision that we take as a part of FM is to achieve this particular objective so that our shareholders, they are able to get maximum returns over the long term. That is why we say that it is wealth and not just profits. So we had learned about that. What else did you learn as a part of chapter 1? What else did you people learn in the last class? The 3 E's, we learned how do we do the performance evaluation for a not for profit entity. The types of decisions do we have to make. What are the 3 decisions that we learned the last time? Investment, financing, dividend. Absolutely. These were the 3 types of decisions that we do as a part of FM. And we learned what all these different decisions are all about. What do we decide as a part of these 3 decisions? All right. So now we left off in chapter number 1, where we have learned all about the different kinds of decisions that we take as a part of FM. So now we are moving to one decision, which is about the investment decisions. In the coming chapters, you will learn about financing decisions also, as well as the dividend decisions. So whatever we as a financial manager will be required to do in a company, we will be getting the entire knowledge of that in the FM paper. So here we are firstly getting started with the investment decisions. Where is the company going to invest? How is the company going to take the decision where we should invest? This is what we are going to start off. This is, you can say, one of the first main units of the FM syllabus. Rather than just knowing about what FM is, what is the environment, here we are finally getting deeper into the very first topic, where we are going to learn all about investment appraisal. So we will learn how do companies decides related to the investments. So as you can see, the name of the chapter is in front of you. The name of the chapter is investment decisions. Here, what all are we going to learn? In a summary, you can have a look. A good flow chart has been given to us, that what all we are going to learn as a part of this chapter. So we will first of all learn what is the process of making the decisions. There are multiple types of expenditures that we do in a company. We will first have a quick recap of that. Then we will learn what is the role of investment appraisal in a company. And then we will get started with learning 2 of the methods with which we can actually do the appraisal or the evaluation of the investment opportunities. One method is the payback method, and another method is the return on capital employed method. So these are the 2 main things which we are going to learn as a part of chapter number 3. So let's get started. The very first thing you can see is a quick revision of the 2 types of expenditures which are possible in any business, which is capital expenditure and revenue expenditure. Now, I would probably not prefer to explain this you people, and I would like you people to participate here, because this is a very basic concept. Even if you took up exemptions, this is something you might have learned in your basic commerce studies. What is a capital expenditure? What is the revenue expenditure? And how are they different from each other? You people tell me. Give me examples, whatever way you want to explain it. Just let me know what do you people understand from these 2 terms. Capital expenditure, revenue expenditure. Come on, participate, guys. Okay, so I'm starting to receiving responses. First one, Lekhna says that expenditure that you make on the non-current assets, that is what you do on the capital expenditure. Nidhi is correct. Capital expenditure is something that we incur for the long term. For example, investment, absolutely correct. Kia, also the money that you spend on acquisition of the assets to buy the assets for the business. And then what is considered as a revenue expenditure? Revenue is something that you do for the short term. So a few examples are also put in place over here. Anything that I am buying, any asset which I am buying, or if I'm improving it, it is going to give me a benefit more than 12 months. So that is when I call it as a capital expenditure. So let's suppose I have spent money to buy a laptop for teaching you people. So the laptop that I have purchased, this laptop is probably going to give me a benefit for the next 2 to 3 years, definitely more than 12 months. So this will be a capital expenditure for me because this asset is going to help me do my work. Another type of expenditure is, let's suppose there was a small thing which went wrong with the laptop. Now just to keep it in a working condition, now let's suppose the mouse was not working, so I had to get the touchpad changed again. So the money that I spend over that will not be capital expenditure, that will be revenue expenditure. So the money that you incur on maintaining your non-current assets, on getting them repaired, that is called as the revenue expenditure. I hope you people have studied this before also. You're clear with the distinction between the two types of expenditures? Anyone who thinks that it's the same? You're all with me? Okay, great. So now we will talk about the different methods one by one, which we are going to learn as a part of this chapter. So the very first technique which you can use to make investment decisions is called as the payback period. Now, before we even go to the technical definition, let's break down the word and try to understand what this could potentially mean. So here the word is payback period. So word number one is payback, word number two is period. Now, the word payback also is a combination of two words. One word is pay and the second word is back. Now, what do you people understand just by breaking down this term? Can you give a rough meaning that what could this possibly mean? Payback. What does payback mean? Absolutely correct. Madhumita says that the returns that we get from an investment. So what happens is, if let's suppose you people go out and do an investment, what will happen? You are going to incur money to do that investment. So if let's suppose you are buying a computer for yourself, so this computer that you buy, let's suppose you spend 50,000 rupees to spend this computer, to buy this computer. Now, this 50,000 that has gone out of your pocket, that is why I have denoted it with a negative figure. This money has gone away from you. That is why it's a minus sign that I have put. Now, payback means how much time will it take for you to get that money back? So, the 50,000 that you have spent, why have you spent? Because you will do some business using this computer. So, let's suppose the cash flows that you will get from the business in year one, you will get 20,000. In year two, you will get 30,000. In year three, you will again get 20,000. So if I ask you people, how much time will it take to get the initial money back? What will be your answer? 2 years, absolutely correct. In the first year, I recover 20,000. In the second year, I recover 30,000. So total 50,000 is fully recovered. So this is the very definition of payback period. Now let's get to the technical definition also. In simple words, what have I told you? Payback period is the time that it takes for us to recover our initial investment from the project. So now let's have a look at the technical definition. Payback period is the amount of time that it takes for the undiscounted operating cash flows from a project to pay back the initial investment. So just a few fancy words have been used. Otherwise, whatever meaning I've explained to you, the definition is also saying the same thing. Just one thing has been used over here, undiscounted. How many of you are familiar with the concept of discounting? Discounting of the cash flows? How many of you are aware of it? Even if you are not, it's totally not going to be an issue, but just so that I get an idea. Yes, Samanvay, it's the present value, time value of money. Absolutely correct. Okay, so some of you have an idea, but majority of you, I am taking that you do not know what discounting is. So no worries, discounting is going to come as a part of the next chapter. So till here, we do not need to know what discounting is all about. So I will simply take whatever cash flows I am getting every year, I will add them, and my answer, wherever I recover my initial investment, that is what my final answer is going to look like. And how do we decide? Like I was telling you people, here we are getting the help of how to decide for the investment decisions. So if I want to make a decision using payback period, what is the criteria that I will be using? So companies usually have targets that I want my initial investment back in 2 years. So if my payback period is also 2 years and my target is also 2 years, or if the payback period is lesser than 2 years, I get my money back in 1 year or 1.5 year when my target is 2 years. So then I can accept this project. But if my target is 3 years, it is 2 years, and this project is taking 3 years to return that money, I want my money back in 2 years, but this project will take me 3 years to get the money back. So do you think the business can take up this opportunity? No. So we will reject in that particular scenario. So here the decision rule has been summarized for you people, that if the payback period is lesser than the target, or even if it's equal to, then you can accept. If the payback period is more than your target, then you have to reject it, because you will need the money sooner than it is going to come back in the project. That is why we are going to reject the opportunity or the project. Another thing which we can do is, sometimes what will happen is the cash flows can also be the same. Here you saw that the cash flows were different every year. One year we were making 20,000, another year we were making 30,000. But if every year my cash flows remain the same, which is there in example 1. So if you see the case of example 1, you see that investment is $1.4 million. Annual cash flows before depreciation but after tax are given to us as $0.3 million, and the life of the project is 10 years. That means starting from the first year till a period of 10 years, I am going to receive $0.3 million. So how much time will it take for me to recover my initial investment? What is the formula that we can use? If the cash flows every year are the same, only then you can use this formula. You take your initial investment and you divide that by the annual cash flows, which are the same every year. So what do you take? The investment that we have is 1.4 divided by 0.3. So your answer is going to work to 4.7 years. That means the business is going to take 4.7 years to get the initial investment of $1.4 million back. So this is the numerical as to how do you people solve for the payback period numericals. Any doubts still here? Are you all with me? Any queries, guys? Okay, great. So now we will talk about the advantages and the disadvantages of the payback period method. So the very first advantage that you see in front of you is that it is simple to calculate. We just learned it, and it probably took us a few seconds to learn how to calculate the payback period. So the first benefit is that it is simple to calculate. Another benefit that we have associated to the payback period is that it is easy to understand. Everyone understands this. Even if you are a person who does not belong from the finance background, you will be able to understand the meaning of payback period, that this is the time that it will take for us to get our initial investment back. Even if you are not a finance person, money is one thing which everyone understands. So if I tell you that the payback period is 2 years, it will be very easy for you to understand that, okay, if we are incurring $1 million, that $1 million will come back to us after 2 years. So this method is also easy to understand. Another benefit is that it concentrates on the earlier, more certain cash flows. Now, what do you people interpret by this point is, if I tell you that I want you people to predict what will happen tomorrow, versus another case is I tell you that you should predict what will happen 10 years later. So, according to you people, what will you be able to predict more accurately? Something that happens tomorrow or something that happens 10 years later? Which thing will you be able to predict better? What will be the weather tomorrow or what will be the weather 10 years later? Obviously you will be able to tell tomorrow's weather with a much better prediction. So what happens is, the more future I go into, the more the more uncertain my predictions become. Whatever I am predicting, lesser chances of that coming true. So with payback period, what are we doing? We are considering whatever money is coming back to us from the starting of the project. So I am focusing on those things which are coming back to me as soon as they can. So it is a good thing. Why? Because whatever things are given to me in the first, second, third year, they are more certain. Whatever thing is going to happen in the 10th year from now, lots and lots of things can change from then. So maybe if I am thinking that in the 10th year I will earn $1 million, maybe something like COVID-19 happens and my sales targets are not properly being achieved because of that. So something so much into the future is very much difficult to predict. That is why, because in payback period, I'm focusing more on the cash flows which are lying in the beginning of the time frame. That is why it makes my answer a more accurate answer, and it gives my method also a bit of superiority, because I'm considering those cash flows. My answer is based on those cash flows which are more certain, which have more probability of being there rather than the later cash flows. This is the third benefit. And the last benefit that you people see over here is that my focus is on quick recovery of the capital. Why do businesses want to recover the capital quickly? Does anyone want to answer this question? Do you people know? If you are a business, why would you want to get your initial money back quickly? Think from the perspective of a businessman or a businesswoman. Okay, one thing is that you will be safe if your initial money comes back. At least the possibility of losses will reduce. What else? You're all thinking towards risk and loss. Think from a business perspective. Liquidity. Okay, that's also one more thing. Profit is going to be earned faster to invest in other projects. That is what I was looking for. Whatever money comes back to you from one investment, now you can use that same money to invest in another place. So this is how a business person thinks, businessman or businesswoman. Everyone thinks how we can make our money work for us more and more. So as soon as the money from one project is coming back to me, I will throw it into another project, so that the new project also now starts to give me the profits and the returns. So here my focus is to bring the money back quickly so that the business can keep investing in more and more profitable projects. So this is also one advantage. So these are the 4 advantages associated with the payback period method in front of you. Now let's also talk about the disadvantages, and then you people can ask any queries if you have. Disadvantage number 1 is that we are ignoring all the cash flows that happen after the payback period. So for this, I will take you back to the numerical example that I gave you. 20,000, 30,000, till here we saw that in year 2, we are able to recover the entire $50,000. Did we do anything related to the $20,000 that I'm receiving in the third year? Did I consider that? No. So here the disadvantage for this method is that I am not considering the cash flows which happen after the payback period. So maybe after the payback period, something very bad happens. Maybe the cash flows run into negative. So I may run into losses. But with payback period, I will just stop at where I am getting back my initial investment. I am not caring about the other factors. That is why we are putting it as a disadvantage. Another disadvantage is that the target period is subjective. Where did we use this word target period? In the decision rule. In decision rule, what we are doing is, whatever answer we get, 2 years was the payback period we got, we are comparing it with our target. Now, who sets this target? This is not set by God or some any external power. This is set by the management themselves. When management, who is management? Management are also human beings. Human beings can sometimes make mistakes, human beings can be biased. So because this target period is subjective, what I am comparing my payback period to is a subjective thing. It can be more or less than it should be. So maybe I take the wrong decision because the target was set incorrectly. This is disadvantage number 2. Disadvantage number 3 is that I am ignoring the time value of money. Time value of money is one such concept which we are going to learn much more in detail in the next chapter. So just bear with me till now, till we start off with chapter number 4. You're going to learn what exactly is time value of money. Just to get an idea, you people would understand this with the help of this real life example. Let's talk about the price of Maggie. You all know about Maggie. Do you like Maggie? I'm honestly a very big fan of Maggie. I love Maggie. So, what you observe with the price pattern of Maggie is, if you talk about probably 4 5 years back from now, a packet of Maggie costed you 10 rupees. But now, the same Maggie packet, how much does it cost you guys? 14 or 15 rupees, depending upon where you buy it from, 14 or 15 rupees. So if you want to buy the same packet of Maggie, let's suppose you kept some money in your pocket, you're in 2020 right now, in your pocket you have 10 rupees at the moment. So in if you are in 2020, you can still buy that packet of Maggie with that 10 rupee note that you have in your pocket. Now let's suppose you time traveled, you saved that money with you, you time traveled now into 2025. Can that same 10 rupee note get you that packet of Maggie? In today, in 2025, can you get that packet of Maggie? No. So what happens is money loses its value over time. There are multiple reasons why money loses its value. We will understand it in the next chapter. This is called as the time value of money. We are ignoring the fact that as soon as we are moving to the next year, the value of money is reducing. If I have 10 rupees today, what I can buy with that 10 rupees right now, I will not be able to buy that same thing using these same 10 rupees maybe 3 years from now. So this is the time value of money. Another disadvantage that we have with this method is we are not measuring how much change in the wealth of the shareholders is coming. How do you calculate the change in shareholder wealth? What will be added to the profits of the company? But in the payback period, did we do any calculation related to profits? Is there any number or any working that we do? No. So we are ignoring how much profit the project is making. So we are ignoring our final objective. Why are we doing all of this? Is because we want to maximize the wealth for the shareholders. So if I am not looking at profits, then what is the point? I am not looking at what will it add for my shareholders, then what is the point of this particular method? So these are the disadvantages which are associated with the payback period. Give the 4 advantages as well as disadvantages a quick read. Let me know if you have any doubts. Then we will proceed to the second method that we have. Any queries? Okay, Aman wants me to repeat the advantage number 3. Advantage number 3 tells you that we are focusing more on the earlier and the more certain cash flows. What do we mean by that? So if let's suppose in the numerical that I gave you, Aman, there were these many years. Let's suppose in year 5 or year 4 also there was money coming in $10,000. In year 5 also there was money coming in $10,000 again. But when we were calculating the payback period, what did we do? We stopped at those cash flows. After those cash flows, we stopped calculating till the time we recovered our initial investment. And to recover our initial investment, which years did we consider? Did we consider year 1 to 3, or did we started to consider from the last years, year 5, 4, 3? What kind of years are you considering? The earlier ones, 1, 2, and 3. So you are focusing on the earlier cash flows. Why is focusing on earlier cash flows a benefit? Because the more future you go into, the more ahead you go into the future. So if I try to predict something 10 years from now, that prediction has higher chances of going wrong. But I try to predict something that is happening tomorrow, after 1 year, after 2 years, compared to what will happen after 10 years, I will be able to predict it with a lot more certainty, with a lot more confidence that yes, I am confident that this is going to happen in the next 2 years. So, because we are focusing more on the early years, we are focusing more on the cash flows which are certain. There are lesser chances of these values changing. That is why this is an advantage. Is this clear now? Did you understand now? Everyone else also? Okay. Another doubt has been asked to repeat the second disadvantage. So the second disadvantage that you people see over here is that the target period is subjective. What do we mean by the target period being subjective? I told you people that the decision rule that we have, how do we decide that will we take up the project or will we reject the project? The decision we take using our final answer, and we do a comparison with the target. So who sets this target? This is set by the management of the company, that we are targeting that all projects should give us back our money in 2 years. Now, me being a human, if I have set this target, is there 100% surety, Ms. Ba, that I'm going to set the right target for the company? Is that 100% certain? No. So maybe because I'm a human, I may make some error. I may include some personal bias over here. Maybe I just want to recover the money quickly and quickly, no matter what happens to the profitability. So that's a bad thing for the company. So sometimes I can deliberately set the targets wrong. Sometimes there can be error which I can make. So whatever target that I'm setting, it is something which is being decided by me. It is subjective to me. So because of these mistakes, now if I am comparing, let's suppose the target of 2 years that I have set is a wrong target for the company. There was one very good project which could have added millions and millions dollars to the wealth of the shareholders. But just because of my stupid target of 2 years, the project was giving us money back in 2.5 years. Just because it did not meet my 2 years target, we rejected the entire project. So do you think it's a good thing to reject a project which could add millions and millions to the wealth of the shareholders? Will it be a good idea? No, right? So that is why we are putting it as a disadvantage, that because of the target period being subjective, we can sometimes make wrong decisions when we are using the payback period method. Okay, is this understood? Any other doubts? Now, is everyone with me till here? Let me know if you have any other doubts. Okay. Now we proceed further to the second method that we are going to learn as a part of this chapter. The name of the second method, as you can see, is the return on capital employed method. This is not something which you people are not familiar with, because you have already done this as a part of the chapter 19 ratio analysis also. So what we do as a part of return on capital employed is we basically see that on the investment that you have made in the company, how much profit you have generated. So return on capital employed, the definition is how much is your average annual operating profit as a percentage of the initial or the average investment. So in the numerator, you're supposed to take how much profit your project or your investment is earning every year. You divide that by either your initial investment or the average investment. The method which you people have to use, this is going to be specified for you in the question, that do you have to use the initial investment method or do you have to use the average investment method. And how do we calculate the average value of anything? Even though the formula is given to you, when I have to calculate the average, what is the formula that we use? To calculate the average of anything, what do we do? Absolutely, you take the sum of the observations and you divide it by the number of observations. So if I want to find out my average investment, I will take my opening value, I will add my closing value, and I will divide it by 2 so that I will get the average investment. So you have the formula given to you people over here, that average investment is the initial investment plus the scrap value divided by 2. This value is going to give you the value of your average investment. So the decision rule in this case is going to be, here also the management is going to set a target ROCE, that we want to achieve an ROCE of 20% on all of our projects minimum. So if let's suppose a project has come up where it is offering me a 25% return, then if my target is to get 20% and one project is offering me 25%, what will I do, guys? Will I accept it or will I reject it? My target is 20. I'm getting 25 in this project. Is this a good thing or a bad thing? Should I go ahead or should I reject? Yes, I will accept it because I want to achieve 20, but this project is giving me more than what I want. So definitely it's a good thing for the company. Same scenario, if my target is 20 and one project is offered to me, which is giving me an 18% return. Should I accept this project or not? We will reject this project. So the decision rule has been given to you over here in a summary, that if your ROCE is more than the target, then it's a good thing, accept the project. If the target is more and the ROCE is less, then you are going to reject the project. So this is how we are going to decide whether we go ahead with this or not. So this is the decision rule. Once you calculate the ROCE, you will compare your answer with the target. If it is more than the target, then you take it up. If it is less than the target, then you reject it. So is everyone with me till here? We will now practice a numerical if you're all with me till here. Noted down the formula? Okay. So note this formula with you. I am now taking you people to the ACCA study hub. Now the study hub should be visible to you. Can you give me a quick confirmation if study hub is visible? Okay, great. So let's solve activity 1. You people solve and let me know your answers. You are supposed to calculate the ROC. There are 2 parts. First part wants you to calculate on the initial investment method. Second method wants you to use the average investment method. So do your workings. Let me know your answers. I am waiting. Okay, I have received some of the answers in the chat box. Manya says 55 million. Your answer cannot be in million terms because ROCE is always expressed as a percentage. Samanvai says 62.5, and there are multiple types of answers that I'm receiving. None of them are actually matching. So, no problem. Let us solve this together. Also, just to inform you people, I have created one separate Google Doc for you people. So any numerical questions that we will be solving in class, I will ensure that I solve it over here on this sheet, so that even after the class, if you people want to refer back to the calculations again, you can come back to this sheet and have a look at the calculations. So I will just rename this. This is chapter number 3 that we are doing. So chapter wise, we will keep naming, and whatever question we are solving, we will also put the name of that question, so that whenever later, if you come back to it, you get to know exactly where what thing has been answered. So the very first part wanted you to calculate the ROCE based on the initial investment. ROCE on the initial investment. So here, what is our formula that we have learned for the ROCE? What is the formula that we have learned, guys? It is the average annual profit. You can see it's not very far. The formula is right over here. Average annual profit, which I have to divide by the initial investment. So here the cash flows have been given to me, but I need profit. Is there any difference between the cash flows and the profits? Cash flows is simply the money that I am receiving, but within the business, I will also be incurring some expenses. Those expenses also have to be subtracted if I want to find out my average annual profit. So what do I do is I will first calculate how much are the total cash flows that are going to arise from this project. So you can see that in the first year I get 100 million. Then I get for year 2, 3 and 4, I get 50 million every year. That means if I put it year wise, year 1 I am getting 100, year 2 I am getting 50, year 3 I get again 50, and then year 4 also it is year 4 also it is 50 again. So if I see how much is the total of the cash flows that I am going to generate from this project, this is going to be $250 million. Now this is the cash flow that I have calculated, but for my numerator I need the average annual profit. So for calculating the profit, what do we need to do? Whatever cash flows that we have, I have to subtract my expenses from there. So expenses, there is nothing else that has been given to us. Only one thing which I can figure out is that because I'm having some initial investment and some scrap value, I get a machine for $200 million and I sell it off for $20 million. That means how much will be the total depreciation that I charge on my machine? On my investment, how much is the total depreciation, guys? 180, absolutely. So you are going to subtract this is the total of your cash flows, total cash flows. Then you subtract the total depreciation. So total depreciation will be 200 minus 20, which is going to give you 180. So that means your total profit over the entire 4-year period is going to be the cash flow minus the expenses, which will be 70. So if I want to find out the average annual, this profit I will be earning over 4 years. So if I want to find out the profit for 1 year, guys, how can I do that? How can I convert it into 1 year's profit? Absolutely correct. We will divide it by 4. So 70 divided by 4 will give me my average annual profit, which is going to be $17.5 million. Now, finally, I have my numerator. What is the denominator that we are supposed to take? Over here, our denominator is supposed to be the initial investment. So I have my average annual profit to be 17.5, and then I know my initial investment. Initial investment is directly given to me over here as $200 million. So what is going to be the ROCE? Numerator divided by denominator. So if I convert it into a percentage form, 8.75. Let's answer to two decimal places. So we can say that 8.75% is the return on initial investment. Is part A clear and understood by everyone? Let me know if you have any doubt in any of the steps of the working. Is everyone with me? Okay, perfect. Now we move to the second part. Second part, the numerator remains the same, just the denominator has to change. And denominator in this case has to be the average investment. So for the average investment also, we have just learned the formula that you take the initial investment plus the scrap value divided by 2. So my initial investment is 200 and my scrap value is 20. So I take 200 plus 20 and I have to divide this whole number by 2 to come to my average investment value. So my average investment is 110. So now if I want to find out the ROCE on average investment, I can do that using 17.5 divided by 110. So if I convert it to a percentage, this is what it is going to look like, 15.91%. Okay. Any doubts? This is the entire answer for activity 1. All good? Should we proceed ahead? Okay, great. Great. So what we are going to do next is talk about the advantages and disadvantages. Then we will solve another numerical together. So just to talk about the advantages and disadvantages of this particular method that we are studying about, the ROCE method. Firstly, talking about the advantages, very first advantage that you see over here is that whatever information that you need to calculate the ROCE, if you have a look at the formula, you only need numerator and the denominator. What is the numerator? It is the profit. Denominator is the investment. So both the numbers that you need, the raw material that you need, the ingredients that you need to calculate this ratio, these are very easily available. So you do not have to search very hard for these numbers. These numbers are very easily available in the accounting information of the company. Second advantage that you see is that it is simple to calculate and also understand. Return on capital employed, we have just seen the calculation, it's very easy. Understanding wise also, you can see that it is very easy. If you just tell someone that 20% is the ROCE, so that person will easily be able to understand that, okay, if $100 were put in, we have created a profit of $20. Another benefit that you see is that financial analysts often use a ROCE method to appraise the performance. So here I will also give you people a real life insight. Like I told you people in the first time we met, that I work as a portfolio strategist and a derivatives trader. So when I am strategizing the portfolios for my clients, what do? I look for the shares of those companies which provide the good returns to the shareholders. I want my client to make maximum profit. So what do? I look for companies who have high ROCE numbers. So most of the analysts all over the world, the way the people invest in the companies, they all look for a good ROCE in a company. So if my projects also are evaluated on a good ROCE, so I will only, as a company, I will only take up those projects which have a good ROCE. So if my projects have a good ROCE, what will be the ROCE of my company look like? Will it also be good or not? If my projects are giving good returns, then the company ROCE will also be a good number. So if you use ROCE to appraise your projects, to evaluate your projects, it also helps to better your position for the investors. More and more people will want to invest in your company, and it will be easy for the company to gain money in the future, gain funds for the business in the future. So these are the advantages which are associated with the ROCE method. Now talking about the disadvantages also, nothing in the world is going to only have advantages. There will always be disadvantages associated with everything. So what are the disadvantages with ROCE? Number one, you have different calculation methods. So just now we have learned that we can calculate ROCE on initial investment also and on average investment also. So let's suppose somebody company A has calculated the ROCE on initial investment, and company B has calculated the ROCE on average investment. Do you think it will be fair to compare both of these numbers? Will it be a good thing to do that? No, because the method of calculation is different. So because the method of calculation is different, that is why it is a disadvantage that you cannot compare it if people have used other methods. Another disadvantage that you see is that this ROCE method is based on profits rather than cash flows. We have already discussed that profits are different from the cash flows. But here the perspective is a little bit different. Why do people think that it is bad to calculate something based on profits and not cash flows? Think a little bit from a broader perspective, then only you'll be able to get to the answer. Why is it bad to use profits and not cash flows? Where do we get the figure of profit from? I'll give you people a hint. Where do you get the profit figure from? Where do you get the profit figure from, guys? P&L account, absolutely. P&L account is the part of the financial statements of the company, the books of accounts of the company. Is it not possible for any person, any accountant, any board of director to massage the numbers, what you also call as window dressing? There is a possibility of manipulating, absolutely. So there is a possibility of manipulating the cash flows. So if I calculate my ROCE based on a profit which was calculated using manipulation, then don't you think my ROCE figure will also give me a false impression, a misleading impression? Yes. So because we are taking profits which can be manipulated, here it will be a disadvantage to run a number to calculate a decision making technique using the profits which can be manipulated. Another thing is that again we are ignoring the time value of money. We are not considering the fact that whatever you can buy with $100 today, you will not be able to buy that same thing with those $100 some years later. So we will overcome these difficulties. You have seen these difficulties in both the methods that you have learned in this chapter. So in the next chapter, we will learn how to overcome this problem. How do we solve the problem of the time value of money? Then again, the target rate is subjective, the same disadvantage as the payback period, that whatever our decision rule was, that whatever answer you get for the ROCE, you compare it to the target. Now again, the management is going to be setting the target. So if the management sets a wrong target, maybe by intention, maybe by chance, maybe not knowing that they were making a mistake. So if I take the wrong decision basis that target, then the method is not going to give me a right answer. Another thing is that another disadvantage that you see is that it gives me a relative measure. That means a percentage measure. So how do you give your answer for the ROCE? Right now also what we calculated, 8.75%, 15%. So here our answer is in terms of percent. So do you people get to know with just these numbers, 8.75%, do you get to know how many dollars exactly will be added to the wealth of the shareholders? Did you get to know that? No. So again, this is a disadvantage. Maybe you are earning, let's suppose the entire wealth of the company is $100 billion. I invested in one project over which I had to spend $10,000 and it gave me a return of $20,000. So basically my money has doubled. So if I calculate the ROCE over here, it will look like 200%. But do you think somebody who has hundreds of billions of dollars will care about $10,000 in returns? Will it be a good return for them? No. So having ROCE can actually mislead a person, because you're not getting to know exactly how many dollars are the shareholders earning extra because of taking up the project. So the next techniques that we will learn in the further chapter, these techniques are going to overcome the limitations that we have learned over here. We will learn one technique where we get to know exactly how many dollars will be added to the wealth of the shareholders if a particular project is taken up or not. So these are the advantages and disadvantages in front of you. Read through them. Let me know if you want any further explanation, and then we will move to one more numerical that we have on the study hub. I'm giving you 1 minute. All right, Madhumita is asking the second disadvantage again. So the second disadvantage reads that it is based on profits and not cash flows. So I told you that this is a disadvantage. Why? Because the ROCE calculation that you are doing, both of the numbers you see, if your numerator as well as denominator, both numbers that you are seeing over here, these are the numbers that you take from the books of accounts of the company, from the financial statements. And these financial statements, it is a very big possibility, it is a very big chance that these numbers can be manipulated. The profits can be manipulated. You increase your sales, or you decrease your expenses, or you increase your expenses depending upon what I want to do. So as a manager, I have multiple techniques which I can use to manipulate the profits. You will usually see companies doing these things. What happens is, if I as a company want to pay lesser income tax, so what will I have to do? I will have to show lesser income. So for lesser income, what will I do? I will try to increase my expenses. I will deliberately put in expenses which are never even incurred. So these are a few techniques which companies keep on using depending upon what they want to show. To the tax authorities, they want to show lesser profits. To the shareholders, they want to show more profits. So they will try to understate the expenses. So because the numbers are very easily manipulated, whatever ROCE figure that I calculate using those manipulated numbers, that ROCE will also not be very useful, because that ROCE is based on numbers which were not correct in the first place. Okay? All right. Any other queries, guys? Anything else that you want me to explain further? Sure? Say yes or no. You're all with me? Okay. All right. Now we will proceed further to the ACCA study hub for a numerical. All right. Here is activity 2. Try and solve this and let me know your answers in the chat box. Anyone with an answer yet, at least for the first part? Okay. All right. Different answers again. No problem. Is everyone done solving? Should I solve it for you people now? Let's solve together. All right, let us solve this together now. So, activity 2 tells you to calculate the three things mentioned over here. Firstly, I am supposed to calculate the ROCE. Until and unless nothing is mentioned, by default, I always use the initial investment approach. Second part, it wants me to calculate the ROCE using the average investment approach. And the third part, it wants me to calculate the payback period. So the information is telling me a project is being considered that will require a machine costing $80,000, which is expected to be scrapped at the end of the project for $4,000. Market research of $8,000 has already been carried out and capitalized as an asset. So whatever market research I have done, this is also an asset which I will be charging depreciation upon. Then the project is expected to last for 6 years and generate net cash inflows of 20,000 for the first 3 years and 15,000 each of the last 3 years. The cash flows are going to arise evenly during the year. So whatever information has been given to me, I will first put in that. This is activity 2 that we are solving. So if I talk about the cash flows for the company, so for the cash flows, it is telling me for year 1, 2, and 3, I am going to get 20,000 every year. 1, 2, and 3, it will be 20,000 every year. And then for the next 3 years, it is telling me 4, 5, and 6, it will be 15,000 every year. So 4, 5, and 6 will be 15,000 every year. So now if I want to find out the average of my cash flows, I will have to take the total cash flow and divide it by the number of years. So this is my total cash flows. And if I want to find out the annual average, or we can simply calculate it for the profit itself, this is the total cash flow. Then I also have to find out the total of the expenses, which will be the total depreciation. So as per the information that is given, guys, how much will be the total depreciation that I will charge? I bought a machine for 80. This will be sold for 4. So $76,000 I will charge for the machine. And then the market research also, which I have capitalized as an asset, I will be writing off this 8,000 also by charging depreciation every year. So total depreciation that will be chargeable will be $76,000 plus the 8,000 on the market research. So this is what the total of my expenses are going to look like. Um, so this is 76,000 and 8,000. I put 10 extra. All right. So now what do we do is we calculate our total profit. So the total profit will be the total cash flow minus the total expenses, which is $21,000. And now I can find out the annual average value. So the annual average is going to be, you take the total profit that you're going to have and you divide it by the number of years, which in this case is 6 years. So $3,500 is what your average annual profit is going to look like. Then the next thing which you are supposed to consider, for my denominator, I need my investment. So if nothing is mentioned, I by default calculate it on the initial investment. So the initial investment will be the machine that I have purchased as well as the market research that I have done. So $88,000 is my initial investment. So my ROCE figure is going to be equal to the annual average profit divided by the initial investment. So if I convert it to a percentage, roughly you can say 3.98% or 4% you can give your answer as the ROCE using the normal initial investment method. Is everyone with me till here? Any doubts? This is the first part of the requirement. All well? Okay. Now let's proceed to the part B where I have to calculate the ROCE using the average investment. So my numerator is going to remain the same. Annual average profit is the same. Let me just work around the average investment. What is the formula that we have learned to calculate the average investment? Average investment will be the opening investment plus the scrap value divided by 2. So the opening investment which I have is 88,000 and I have to add the scrap value. Scrap value is given to me as $4,000. So 88,000 plus 4,000, divide this value by 2 and this will give you the average investment. So now the average investment method ROCE will be 3,500 divided by 46,000 and this is going to be roughly you can say 7.6%. So this is the answer for the second part. Now, shall we move to the payback period? Okay, I have one query. Can you please explain why market research was included? So, Samanvai, basically the terminology, the way that they have given us the question, they have already told us that the market research of 8,000 was carried out and it was capitalized as an asset. So this is the whatever market research that you did, this was some big information. Because of getting this information, your business was able to do more of profits. So something that gives you benefits for a period of 6 years. There were two types of expenditures that we learned. One is the revenue expenditure, one is the capital expenditure. We said revenue expenditure will be a expense that we do which gives us a benefit for lesser than 12 months. But this market research that we did, how long did it give us a benefit for? How much did our project last for? 6 years. So it is a capital expenditure that we did. That is why it will be classified as an asset. So whatever asset the business has, we have to charge depreciation on that asset. So we are including the market research as an asset in the initial investment also. And that is why we are also charging depreciation of 8,000 on the market research also. So we will write off this 8,000 over the useful life of the project. Okay. All right. Any other doubts still here? Part 1 and part 2 have been solved. Here is the numerical in front of you. Let me know if you want me to clarify anything. Then we will solve the part 3. You're all with me? Okay, so now let's solve the third part where they have asked us to calculate for the payback period. So what do we do in payback period? We're supposed to find out, have we recovered our initial investment or not? So in this case, the initial investment for us is $88,000. So that means I start off with a negative $88,000. I will stop. My payback period will happen when I have recovered this entire 88,000 back with me. So when the first year is over, the money that I have with me is $20,000. When the second year is over, I have a total of $40,000 with me. When the third year gets over, I have 40,000 plus 20,000 more. That means I have 60,000. So far, have we recovered the whole money that we need? No, that means we need more money. How much more money do we need? I spent 88 and I have recovered 60. That means I am yet to recover 28. So I need this 15 also entirely. So 60 I had before, 15 more I got. So 4 years have passed. So far I have recovered $75,000. Now in the next year when I get the money that I will be having now will be equal to $90,000. But do we need entire 90 to have the payback? No, we only need the portion to get to 88. That means 2,000 extra is being over here. So if you talk about having 75, how much more do we need? 88 minus 75, I only need 13 more. But in the fifth year, I am getting 15 more. So that means my payback period has to be lesser than 5 but more than 4. So how will I find out the ratio? How much do I need more? I need 13 more. How much am I getting in the fifth year? I am getting 15. So I need to have this much portion of the next year back with me. You can take 13 divided by 15. That means I need 0.86 years after 4 years. So that means my final answer will be 4 plus 0.86. That means my final answer will be 4.86 years will be the payback period for this particular project. So it is going to take me lesser than 5 years, roughly 4.86 years to get the initial money back. Okay, is this understood, guys? You understood the working of how we got to 0.86? Any doubts in that? Rest everything is very easy. Okay, Harshit, what is your doubt? Harshit, what did you not understand? Oh, okay. You mean no doubts. Okay, no problem. All right. So with this, we come to an end to this particular chapter. You can see our chapter is concluded. So as we always do, we are going to head to straight away the quiz for this chapter. This is chapter number 3 that we have done. Although nobody asked me, but I am going to give you the reason why did we not go to chapter number 2. We finished chapter number 19 first, then we went to chapter 1. Now we straight away went to chapter 3. Where did chapter 2 go? So I told you people a little bit about it in the orientation also, that chapter 2 is a very lengthy, entirely discussion based, like it's a conceptual based chapter with no numerical questions. So that is why the way that we are going to do this chapter is, we will every day learn, in every class that we meet, we will learn small portions from this chapter, so that we are not covering all of the theory in one go. It may be boring for you. You may not be able to retain everything. So I will break it down into small digestible parts for you, so that you not only understand everything properly, but also are able to remember the concepts at the back of your mind. So chapter 2 we will do in installments. All right. Now let us get started with the quiz for chapter number 3. I have the first question here in front of you. Think properly and let me know your answers. Yes, Likhna, chapter 3 is finished. I just showed you on the study hub. The activity 2 which we have solved, that was the last activity that was there as a part of this chapter. This was a smaller chapter. Now the chapters to come are going to be proper lengthy chapters. Okay, so the first question is here in front of you. Let me know your answers. All right, I'm starting to receive a lot of answers. Let's read the question together. Which of the following statements concerning the payback method is correct? So we have learned in one of the disadvantages that we do not consider the time value of money. This is correct. We will learn in the next chapter how to take into account the time value of money. The next statement is, it is the time required for profits to recover the initial cost of the investment. We know that this is incorrect, but can I change some word which will make the statement to be correct? What word can I change and what will the changed word be? Read the statement, let me know. Cash flow instead of which word, Levin? Absolutely correct. So if I tweak this statement and I say it is the time required for cash flows to recover the initial cost, then the statement will be correct. Because it says profits, that is why it is incorrect. Third statement says we consider the whole life of the project. Do we consider the whole life or do we consider only some part? And the part that we consider, what is it called? What portion do we consider in the payback period? We only consider that part of the life of the project till the time the initial investment is recovered. After the initial investment is recovered, we are not concerned what is happening. So we are not looking at the whole life. We are only looking at that life of the project till the time we get our initial money back. So this is why this is incorrect. And the last one says that it is reliable for project selection decisions. This is not reliable. You will learn that the most reliable technique is the technique which we will learn in the next chapter, which is called as the NPV method, the net present value method. So stick with me till then. Are we all good? Should I take you people to the second question? Okay. Here is question number 2 for you. Very easy. Shouldn't take so long. Come on. Okay, receiving answers, most of you are saying B, or just one answer, I think Livin said C. So let's see, we are supposed to say that which of the projects will achieve the payback within 3 years. So there are three projects which are given to me, A, B, and C. If I try to calculate the payback for project A, I am going to get my money 3,000 plus 3,000 will be 6,000. I need another 3,000 to get to 9,000. 3 years have passed, but still I have not received my money back. So project A has to be eliminated. Then if I talk about project B, $25,000 is what goes away. I get 15. So I now need 10 more. In the next year itself, I get 15,000. So my payback happens before the third year itself. Similarly, in project C, 10,000 is what I pay. 5,000 I receive, another 5,500 I receive. So I more than recover my investment within 3 years. So project B and C is going to be my answer. Livin, you got your mistake. Is everyone with me on this? Should we proceed further? Okay. This is the third question for you people. Again, you're not expected to know the answer here, but I have said it out multiple times. We will learn more about it in the next chapter. Absolutely. It is the NPV, the net present value method, which is considered to be the best method to maximize the wealth for the shareholders. Then let's move to the fourth one. What is the average investment? This is also very easy, guys. Okay, lots of different answers here also, not a very big scope to do that. You have an investment of $340, which will have a life of 5 years, and the equipment can be sold at the end of the 5 year period for $55,000. We are supposed to calculate the average investment. We have learned that the formula for the average investment is opening value. Opening value is given to us as 340,000 plus the closing value. Closing value is the scrap value, which is $55,000. So opening value plus closing value divided by 2 is going to give you your final answer, which will be 197,500, which is option B. Okay. Madhumita, Sharvari, if you were saying option D, I hope you've gotten your mistake. Should we proceed further? Okay. Now let's have a look at the last requirement from this quiz, question number 5. You have to select which is not an advantage. So 4 statements are there, 3 are advantages, 1 is a disadvantage. So you have to pick which is the disadvantage over here. Okay, lots and lots of A's being spammed in the chat box. You're all correct. This is the statement which we have studied as a part of the disadvantages of ROCE, that we take profits rather than cash flows. Profits can be manipulated. That is why it is a disadvantage. Rest all statements, simple to calculate and understand, readily available information, often used by financial analysts. These are all the benefits that we have studied just now for the ROCE method, and we have to select the statement which is not a benefit. Hence, our answer is going to be option A. So with this, we have completed the quiz for chapter number 3 also. You're all with me till here? Any queries, any concerns, guys? All good? Okay. Perfect. So we have finished off with chapter number 3 now. So the practice portion of chapter number 3 is going to be what you practice on your own. So there are 7 questions right over here. And then you have more questions over here. These are 10 questions which pertain to chapter 3 and 4. So wait till the time we cover chapter 4 also, then get to this particular question bank of 10 questions. But in the meantime, you can definitely practice these 7 questions simultaneously to understand how much you have covered the concepts nicely or not. If you face any difficulties, you can definitely reach out to me whenever you want to. You can message on the group, you can message me personally also, right? So this was chapter number 3. Now what we will do is, like I was telling you people, we will break down chapter number 2 in small parts. So it is now time that we cover a small portion from chapter number 2. So let's get started with the today's portion for chapter number 2. Give me just a moment.